Okay, welcome everyone. Uh, can't believe we're already this far in the program. Uh, so this topic obviously is an important one. A lot of you have requested it and have been eagerly waiting. So I hope the wait is over. Today we're going to be talking about money and how you bring money into your respective companies or for your projects. Uh, Fundraising is really not an app name. I should instead label this how to get money. And typically, there are three main ways when you're building a company or an idea. There's three main ways of getting money. The first is via investors, so getting money from uh, VCs, angel investors. Down the road, it will be bigger groups like private equity, high net worth individuals, so on and so forth. The second is via grants and pitch competitions, or broadly speaking, this is called public funding. Public meaning it comes from typically government sources or foundations. And then the final is sales revenue. I know a lot of you are relatively early in the sales process, but one question that will continue plaguing you as you're building your project out is which of these three things do I focus on? How much do I focus on grants? How much do I focus on investors? And how much do I focus on sales revenue? And for some of you, it might even be services revenue. And I'm going to give you the worst cop out answer ever, which is it depends. It depends on where your company is, where your idea is, um, and your specific circumstance. My job isn't to give an answer to you, to be really honest with you. It's to give you all the information so you can make the decision. So that's and that fundamentally is based on these two keywords, credibility and trust. And I know sometimes we use them interchangeably, but I really want to spell out the difference. Credibility is about what you've done in the past. Um, do they believe about what you've done in the past? And this is typically a matter of traction. It could be on, the market research you've done. It could be about the execution risk or the technical risk you've minimized, but it's typically past looking. And obviously it impacts trust, which is forward looking. Do I trust? Trust is about can I believe this team or this person in front of me that they can deliver on the promises that they set out? And obviously these two things go hand in hand, but gaining whether it be sales revenue or grants or investor money is all about credibility and trust. And different investors or different funders will require different levels of credibility and trust. But you should have this mindset of what can I do to show more trust or more credibility throughout the ups and downs of getting money for your respective teams. So this is kind of what the agenda is going to be for today. I'm going to walk you through a startup's financial journey and specifically what to do at each stage. So just quickly here, these definitions are constantly changing, by the way, but as it currently stands, and there's always exceptions to this, but I'm going to use the 80-20 rule here. The vast majority of definitions sort of fall within this category, these set of categories. So the first stage of the journey is what is called pre-seed. So typically there's very high risk on all categories at this point, high market risk, high execution risk, high technical risk. And the people that fund in this category is typically granting bodies, university-based incubators, sometimes friends and family. Incubators like IBZ, for example, will sometimes give out money. I know Velocity does a lot of this type of work. And then finally, also accelerators. And I'll get into the differences of what this is also something that's used synonymously sometimes, what an accelerator is versus what an incubator is. I'll get into the details of why they're different and why you should think about them differently. Then you get into what's called the seed round territory. This is typically in the ballpark of $1 to $10 million. That being said, I have seen seed rounds that are, north of $10 million all the time. It happens, but 80%, as I mentioned, sort of fall within this range, and they're typically backed by angel investors and VCs. Then you get into what's called Series A territory. And this is primarily the angel investors will step away here. And this is where what's called institutional money will come into effect. These are VCs or venture capitalists, private equity firms, and then this third category that is getting more and more active as time goes on, called family offices. Family offices are typically, families that have built generational wealth over decades, and they now invest, in multiple areas, startups being one of the areas that are getting more and more popular. Traditionally, family offices will give their money to a combination of hedge funds or wealth management firms. Sometimes they'll do VCs, but these days you see more and more family offices making direct investments into companies as well. Then you get into the Series B territory. Again, the same category of people at this stage, but what your expectations are typically different. The farther down you go in your financial journey, the more the expectations will be on revenue, on product market fit. Sometimes if you're building something that has high regulatory requirements, like for example, therapeutics, then this will be based on what clinical data you're able to show at each of the stages. And then this sort of continues on. Typically, companies have been raising in good financial markets. They'll end up staying on the private markets longer because a lot of people can put that type of money up, until you eventually hit what's called an IPO. This is when your company goes what's called public and you get listed on a stock exchange. Many complications tied to this. This is much far away. For the vast majority of you, you'll probably just want to know about pre-seed and maybe seed round, and that's going to be our focus for the coming, hour or so. Okay, so without further, so this is what the financial journey of a startup looks like. Let me tell you a bit about the ecosystem and the different players at the early stage. So first you have student grants, and by the way, a lot of these will come off as grants, and a lot of this will come off as public funding, but the intentions are very different, and you have to know a lot of these differences. So student grants are typically about learning goals. Even Lab to Market, although I'm not supposed to say it exactly this way, exists to fulfill a learning goal. We care more about your individual personal growth than we care about you starting a company, which is completely okay by us, but a lot of incubators will retract from saying that. But this is typically the purpose of student grant. They care about hitting learning goals. Government grants, on the other hand, care about what are called economic goals, including jobs created, companies created, patents filed. There'll be different metrics, but these are economic metrics on the basis by which they get money. So the reason to know the why behind each of these organizations is so you can cater and present the right type of case when you're asking each of these groups for money or investment or resources, what have you. Then you have family and friends. This is probably a simpler one in some sense. They basically just want to feel good by supporting you, achieve dreams, and want to back the next Steve Jobs or Elon Musk, especially if it comes out of their family or their close friend circle. Then you have government and university incubators, and they care for getting the name of their university out there, and at the same time also accomplish some economic goals. Private incubators are a little bit different. They want to own equity in your startup so that they can make more money. They're looking for a financial gain, and they'll encourage you to raise more money and typically also provide you with a lot more resources along the way. Um, Accelerators are a little bit different. Accelerators are typically a 3-month to 4-month intensive program. And the purpose here of an accelerator is by the end of those 3 or 4 months, they want you to go raise money. And the reason why accelerators exist is basically to say, is for to take in these underappreciated companies, get them to a point where they're investor ready, and get them to raise a lot more money. So they'll give you some initial money to start off at a low valuation, and by the end of the 3 months, they expect you to raise money at a high valuation by pitching and introducing you to their investor pool. And they're sort of in this sort of flipping business, and in some sense, that's really, really good, especially if you're ready to raise money. But one important thing I have to state at this point is a lot of people will apply to YC or Techstars or any of these incubation programs just because they believe it's like the next progression of their company. You want to make sure that this is the right decision for you, namely that you are ready to raise money by the end of the program. If you're not, you probably are not gaining. You probably should wait until you go into an accelerator program. So yeah, just be mindful of why you're joining an accelerator. There can be other reasons too, but primarily it's to raise capital.
I'll jump in here with a quick comment on the accelerators because I have experience from Techstars. So Techstars is a great program, and so I don't want this to seem like I'm talking down about them, but every program has its caveats. So you need to understand those deeply. The specific example of the caveat in my Techstars program was the corporate sponsor of the program was Stanley Black & Decker, a big tool company. And the in between the lines of the program was that they wanted to invest in companies that would set up an office in their local city. If you weren't going to set up an office in their local city, then that ended the discussion on getting an investor from that corporate partner. And they had their reasons for doing that. Okay, that's fine. But if a situation like that doesn't fit with your company trajectory, then be mindful of that in terms of the outcome you hope to get from the program.
Thanks. That's a good. I didn't know Techstars did corporate partnerships like that, but that's good to know.
Yeah, so the program originally started with simply just Techstars alone. And then as they were trying to grow the program into different cities, they found, I think, some strategic relationships because they had the FinTech accelerator, they have the transport accelerators, and of course, there are all the companies that are the big companies already playing in these spaces. And so that's how some of these big companies get a firsthand look at up and coming startups that they may choose to acquire, or they may want to have a strategic investment in and things like that to play further in their market. So it makes sense, but you just have to be mindful of how does this fit with what I'm trying to do for my company.
Okay, so let's start with the early investor ecosystem. Angel investors they typically want to feel good, but also make money along the way. They're in it to help the people. Venture capitalists, they're a flow through in some sense. They essentially have what's called LPs, which are the investors of the VCs, and their job is to make money from them, and also personally, but the primary driver is getting what's called limited partners and LPs. The new and popular thing that's been coming up is what are called angel syndicates. I highly recommend, if you're planning on raising a few months before you actually end up raising, check out what's called Angel List. A lot of Angel List syndicates are forming. These are people, everyday people who can put a little bit of money and commit that money. And there's people who find companies for these people to invest in. It's kind of like crowdsourcing, crowdfunding investments instead of products. And that brings me to the next point. There's direct crowdfunding platforms as well, where companies can put out their own shares for sale and run their own sort of crowdfunding campaign. The other popular area, I briefly talked about this, is family offices. These days, family offices will also invest directly into startups as well. And then the other player you will get along that isn't exactly part of the investor ecosystem is what's called a sales incubator or accelerator. Their purpose is mainly to help you refine your sales process. This typically wasn't a thing, but it's becoming more and more popular in the past few years. They typically help startups scale and organize their sales process. Um, if you're deep tech, you typically don't need this because you're typically just focused on building product and making sure it works right. But for some of you, this might also be helpful depending on your stage and what sort of how far along product market fit you are. Again, I'm probably giving you here a lot more information than what you need at this point. A lot of this is downstream. I'm just giving you this information so one day when you are ready, you can use this as reference and come back to this information. Okay, so let's talk about raising money from investors. Investors work very differently. I already talked about the difference between angel investor and VCs. A lot of deep tech teams will raise money from VCs, so I want to go deeper into how an investor actually works. So a VC firm structure, investment firm structure is typically the following. They'll have multiple limited partners. These are typically pension funds, sometimes family offices, high net worth individuals, foundations sometimes. They'll pool their money and give it to the investment partners, or general partnership is another word for it. And they will typically create the VC team around themselves. So this will be, they'll put together maybe some management team to run the day-to-day operations. They might hire advisors to the fund that will help them raise money, find deals. Then you have what's called the associates, analysts, and principals. They're doing the brunt of the work of the investment firm. They're helping with what's called due diligence. They're looking at deals and saying, is this a good company to invest in? What needs to be true? Are what they're saying actually truthful? Then you have what's called the due diligence team. This is typically, some scientific or technical or engineering background. They will do research into your specific technology and look into your financials, look into your legals, and make sure that a lot of the boxes are checked off. And then finally, you have, an operations team. This is to help with like the day-to-day fund management. This will help with helping teams, with the portfolio companies help them raise money. Sometimes it's sitting on boards and so on and so forth. But the key here is they're taking somebody else's money, aka the LP's money, and redeploying that and taking a cut of the profits that will generate, and they'll take a small management fee to hire, the team, the VC team, in order to do a lot of the work. It's very important for who you're talking to. As an entrepreneur, it's very, very different talking to an associate and analyst versus talking to one of the investment partners or the investment committee members. You should try speaking to the partners as much as possible and get them to make a case for you, because typically they hold a lot more of the decision-making power. Sometimes certain advisors, if a deal goes through a certain advisor, it's much better regarded compared to the investment partner. And I hope you're starting to realize by this point, these are imperfect systems. Very few investment firms will make a hyper rational decision. There's a lot of sort of politics. There's a lot of who the deal goes through. There's a lot of emotional factors that you'll also need to manage and know of that are written nowhere. And it's something that you'll have to figure out. The good thing is a lot of the discovery work that you're doing right now, you can essentially apply a lot of those discovery skills. Just like you do customer discovery, you should also, whenever you're planning on raising, you can do what's called investor discovery and understand the decision-making process of how this firm chooses to invest in certain companies and chooses not to in other companies. So as Andrea said, I just want to double down, build a great business and investors will come. It's all about, finding the right problem solution fit and then eventually leading to the right product market fit. All these complications aside, this is really, really important. Given the pace I'm going, I was going to go through case studies at the end, but I'm just going to loop them in throughout the presentation instead. So one of the case studies that I had prepared is of GitHub. Anyone here use GitHub? Okay, I see a lot of hands go up. So one of the founders of GitHub was one of my investors. And one of the stories that they're a fascinating story. They ended up raising hundreds of millions of dollars over time. But when they were first getting started, no investor wanted to touch them. And they eventually found a way to buckle down and be really, really cheap and make their cash go far, whatever they had left over. And they essentially just focused on doubling down on revenue and focusing on product market fit. And then 2 years later, they ended up raising a $50 million plus round from like a $1 million seed round. So they skipped this entire territory of raising like a traditional Series A. And they could do this because they had built a great business. They built a product that their customers loved, and the investors ended up coming much more automatically to that. I'll talk about this in a bit, but there's two fears that investors have that you should be very, very aware of as you're going through a negotiation process or even talking to them. The first one is obvious, the fear of losing their money. If I invest in these people, am I going to see my money back? And that's a legitimate fear. But the other fear is just as real, but most first-time entrepreneurs don't know about this. It's called the fear of missing out. If you're an investor that has been around the block and you've missed out on a good deal, you will feel this much more strongly next time a great entrepreneur walks into your office, and you'll fight hard for the deal. And investors by nature are really competitive people, and they will offer slightly better terms to make sure they're part of the round. So you're constantly balancing these two fears. One, the fear of missing out versus the fear of losing their money. And as long as you can use the fear of missing out more powerfully, then you'll most likely end up taking some money from them. So the steps of fundraising, it's super simple. Pick investors you want to talk to, pitch your product and idea, and then, get money. At least this is what I thought. And then I got a harsh slap of reality that it actually didn't work this way. It took me about a year to raise my very first round. It does get easier after that, but it took me 1 year to close out my seed round. So I'll talk about what it actually is like. So over the next few slides, I'm going to be talking about, what you should have ready before you get started, before you are raising, what the pitch should be like and what you should prepare for the pitch, how you should push the investors and how you should negotiate, and then just other notes that you should keep in mind. So here are the things you ought to have ready before you get started. First is your legal documents. So this is things like your incorporation documents, your cap table, who owns what shares of the company. You might want to bring on other co-founders. Some of you already have other co-founders that you work with. You want to make sure all that is documented well and that everyone is in a happy place. After this comes what are called due diligence materials. This is basically these are all materials that help the investor build trust and that you can do what you say you will do. And this will be combinations of, your financial position. At the early stage, though, it's mostly about what work have you done on technology? What traction have you achieved? Sometimes, as a part of the diligence process, if you have pilots, investors will ask for a chat with the customer and get a good understanding of what the customers are saying about your potential product. Sometimes they might even want to talk to somebody who you might not have closed, but an industry expert that knows a lot about the space. And it's especially helpful if you can give them that contact. And again, I hope you can put 2 and 2 together on why we start you off with customer discovery, because it helps you build this sort of base foundation so you can do these types of things later on. Depending on your technology, you might even have a demo ready. I know for some technologies, a demo is not really feasible until you go raise money, and you probably need money to go build a demo. But as long as you have a good argument for why that is, it's typically okay. But you should try having some form of a demo or some type of technical execution traction that you can show. You should have a list of investors that you want to go after. This should be a well-researched list of investors. Either they've invested in similar companies before, they know a lot about the space, they understand the nuances, they can be helpful to you. Whatever it is, you should create a list of investors that you would like to go pitch to. I'll talk about how you get introductions to investors in a bit. Then you have what's called a term sheet. If you go onto the wiki, the IBZ wiki, we've listed a bunch of term sheet templates that you're more than welcome to use. But this is typically the legal document that you will sign with the investor alongside with something that's called a subscription agreement to make the deal official. And then one of the things I did is created what's called a CRM tool. I built it something super duper simple in Excel. You'll be having dozens and dozens of conversations simultaneously. I'm not smart enough, or I don't have the memory to keep a track of all these conversations. So there's many tools out there. You can use whatever. I've created something super simple on Excel that you're more than welcome to use to track this. So it turns out when I started raising, I only had these things ready. I had half of a demo, I had my legal docs, and a list of investors. And the other three things I kind of prepared as time went on. And that's part of the reason why it took me 12 months to raise a round. Most good entrepreneurs are able to raise in the ballpark of 6 to 8 months. So what you should do before the pitch. I'll break this into 2 categories. First, you want to demonstrate higher value. So part of this is getting an introduction from a trusted source. Investors have mafias, where these are trusted people that they'll go to for introductions. It's typically their entrepreneur in residence, an advisor to their firm, or even angel investors will have advisors, or even better yet, a limited partner, which is to say the investor of the investor. The other popular way of getting introductions is through an investor and entrepreneur. One of the things you've got going for you is you've got this vast lab to market network of people who've come before you that have also raised money. And if you're working in similar spaces, I highly recommend speaking with them, talking to them about their investment journey, and potentially even getting a few introductions from them with some of the investors that they met along the way that you might be a good fit for. The third one I'm not so big on, which is press releases. There's so much noise thanks to the information obesity problem that exists now. There's just a lot of information pollution out there. So press releases used to be powerful tools because a lot of investors would read the same type of magazine and entrepreneurship publications. That's not so much the case anymore, but this still works here and there. So part of your investor list, you should also research the investor. What I mean by this is the individual, the potential partner that would be leading your deal, or the analyst or the principal that you're working with. Read about their values. A lot of these people are, how do I say it? they like to think that other people care about their opinion. So they'll write a lot of stuff on Medium and Twitter and all these types of things. And these are good indications of sort of what they believe and why they believe. And you should use this in your pitch. Understand who their professional network is so that you can find a way, have a good idea of who they will go to for asking an opinion about your company, your project. The other thing you should keep in mind is the research on the firm itself. So what other companies have they invested in and what their investment thesis is and how well do you align with that. The other thing, and I didn't put this down here, if you are getting an introduction from an invested entrepreneur, one of the things you out to ask is, hey, what's it like working with this investor? What process do they go by when making this decision? So again, I hope you can see parallels to a lot of the work you're doing around customer discovery and making sure you're asking the right questions when it comes to investor discovery, whenever you're ready for that. So the pitch. Now, people think the investor pitch is this super formal thing. 99%, I shouldn't say, about 80% of times it's not as formal as you'll think. These days, a lot of it happens over Zoom, but now that the world is opening back up, it looks kind of like this. You end up meeting for lunch or coffee or dinner, and you're typically talking in detail about what your idea is, why you will win, what your hidden truths you've discovered, and why you're the best person to achieve this product market fit. We'll go into what questions you will be asked, what questions you should ask in a minute, but it's a lot more informal. It's still very, very professional, but it's a lot more informal than you would think. I would typically just take my iPad and be going through slides in sort of a low sort of impact setting like this. When you're pitching to VCs, they'll typically call you in and hear you pitch, and it'll go through a back and forth. Sometimes it'll be a formal presentation backed up by Q&A. Sometimes it'll just be an informal pitch and it'll be much more conversational. Typically, VCs will bring in multiple people who will be part of the meeting. It could be IRs, it could be advisors, it could be partners, it'd be some combination thereof. If you don't recognize where these pictures are from, by the way, these are from the show Silicon Valley. It's about it's about the entrepreneurship journey of a startup based out of San Francisco. So I hope you can also appreciate what we taught you last week. I hope a lot of the stuff we've been telling you over the past few weeks is coming together. The key element here is telling a compelling story. So this is using the tool like the golden circle, using the tools like schema to make sure you're crafting a story that's compelling and it makes sense. It's not just important for your 5 minutes or your traditional pitches, but just in general in day-to-day communication. You're constantly, when you're talking to somebody on the outside, you'll constantly find yourself in this sort of sales mode where you're always selling your company and making sure it's being presented in this positive light. And the story you typically tell comes down to the thing I shared with you the first time I met each and every one of you. It's typically based around, how do I minimize execution risk? How do I minimize technology and product risk? How do I minimize market risk? A lot of you are focused obviously on market risk at this point, but as you go further down this journey, if you choose to go further down this journey, you'll also be focused on execution and technology risks. So let's talk about other things that you need to have prepared. The 4 pitch decks that I typically have prepared when I was raising my rounds are what I call the intro deck. Sometimes this can even be like an executive summary. It basically goes through, it makes a very succinct pitch about why you should take a detailed meeting with this team. From the investor's perspective, they're looking for problem, solution, market, what makes them special or the unfair advantage, unique value proposition, business model, team interaction, and then obviously vision. The presentation deck, this is typically that thing that I would have on my iPad, and I'd sort of be talking through, these would be talking points that I would walk through. Sometimes we'd all skip slides. It doesn't always go in perfect alignment. But it covers off all those other things. I'm not going to read through them because I think you can do that much better than I can verbally say them. And then the third thing, I typically prepare what's called a take-home deck, which is a more well-written version of the presentation deck, something that can stand alone, and I don't need to be there to talk through all the points. And I typically used to send that to investors after our meeting at the end of the day. So I typically take 4 to 5 investor meetings a day. And at the end of the day, to each and every one of them, I would send them like a take-home version of the deck. And that way they can ruminate and think about what we were pitching and sort of where we were. And then eventually you'll get to what's called the due diligence phase. And the way this happens, by the way, so every week, most investment firms will have a hands-on deck meeting where they'll go through all the deals that they looked at, and they'll make a 5-minute pitch. Each of the partners or the principals will make a 5-minute pitch about your company. And if there's general consensus that, hey, we should go deeper into this company, and this is a company we'd want to move forward with, then you'll be moved into what's called due diligence. Here, they'll ask you all types of more detailed questions to make sure the trust and credibility are there. And this is where what I call the big ass deck or the due diligence deck comes into play, which has detailed information about almost every single aspect of your company and business. So, as some of you have already asked and are wondering, what questions will the investor ask me? So, how did you come up with the idea? It almost always gets asked. And here they're looking for your motivation to work on this problem. And if it's as simple as like, oh, I'm just, it kind of landed on my lap and I'm not really passionate about this space, it's just something I do, it would probably not go very far. They're looking for a compelling story about why you care about the problem you're solving. It could be, cloud-based analytics, something to me that I could find boring, but it might be something that's really, really interesting to another person. As long as you have that, you have a demonstrated passion, that will help continue the conversation. This is a question that comes in many, many forms. What do you understand about this market that others don't? So here you really cannot copy and paste from a market research publication. This typically comes out of your customer discovery. This is probably the most important question you will be asked, because you will typically build your company or an idea based on the hidden insight. I've previously used the example of Uber, of Airbnb, of Google, and all these other companies, but they were all built on this hidden truth that the founders understood about the market, and they held an unpopular opinion that helped them win. This is one of the most annoying questions. Why doesn't X competitor just do this? They have more money, they have more resources. Why don't they just do it? And I used to answer this question terribly. The first few times I got it, I'd be like, they're not, like, I'm the one doing it. Why are you asking me this question? And here what they're really trying to get at is, it's another version of, you will be understaffed, you will have less money than probably the big competitors in the space. How will you win out? That's what they're really getting at. And it's not like you need to have some perfect answer. What you really need is just a plan, and that it's a well thought out plan. Again, a lot of these questions are more about testing you than it is about your idea. Ideas change and evolve all the time, and investors appreciate that. This is much more about what your line of thinking is. Yari, you have a question.
Yeah, as an answer to this question, is protected intellectual property a good answer to why you are why you can do something and a big competitor can't if you have like an intellectual property advantage?
Partially. So yes, some investors will value intellectual property. A lot of them, for them, it's a marketing tool for the most part. It helps them. It depends on the industry. So for example, patents matter a lot in medical devices and pharma. They matter way less in software. They even matter relatively little in traditional hardware companies. The rationale being, let's say I have this amazing intellectual property, or let's say I have this amazing patent. Let's say, some big conglomerate copies me and copies my patent. As a startup, I don't have the money to go sue them. So it's like, yes, you could have a patent, but you're probably not going to stop somebody else from replicating what you do. I know that sounds really, really terrible and scary, but it's really hard to enforce patents. Where patents are valuable, though, is when you are big enough, and when you will get acquisition offers. IP is one of the key areas that is looked at in that sort of acquisition process, because then the larger companies will use that patents to block off other players, typically other big players. I don't know if any of you followed the Apple and Samsung lawsuits. That's the realm where a lot of IP matters. It matters a lot less at the startup level because you typically don't have money to prosecute. Who's on the team? They want to know that you have a well-rounded team. It's not just made up of scientists and engineers. That all, not that having it built completely by scientists and engineers is a bad thing. It's just, even if they are, the roles on the teams are relatively well defined, and they tie well to the problems that need to be solved, primarily within those execution, product, and market risks. Why you will win. This is another version of question number 3. By the way, I'm not going to go into I'm just going to power through stuff because we're going to be short on time. Why is this the right time to start this company? Timing is something that's really, really important. And you should, this is a much easier push in the deep tech world because, for example, for those of you working on like RT lamp, a lot of patents have recently expired, and you can use a lot of those technologies that weren't previously accessible to solve problems like COVID testing or like infectious disease testing in a way that wasn't acceptable before or couldn't be done before. So there's many, many good reasons why timing matters about your particular idea. It might be the evolution of a market that has hit some critical threshold. It might be that some technologies have been developed, ideally by you, that make whatever your business is much, much more viable than it would be 1 or 2 years ago. What is your moat and what is your beachhead? It's something we ask you all the time, and something you should be finding in your customer discovery as well. What keeps you up at night? This is kind of like those questions if you've ever been in an interview, which is like, what is your biggest weakness? You typically don't want to say, I have no weakness, I'm the perfect human being, and no one's better than me. You want to come off in a genuine way and say what's genuinely worrying you and what you plan to do about it. What's your valuation? This is something that investors will ask like, hey, what is the price of the share that I'm buying? And if you don't have any other investors, you probably should say, hey, we're talking to a bunch of investors and we're trying to figure out what a good value for the company is. But based on my analysis of looking at comparables meaning other companies in a similar space, they're raising at X valuation and they're typically raising Y amount of money. And if you already have a set valuation, which means somebody has given you money already, then you can obviously just say like, hey, we've previously raised money at this sort of valuation or cap. you can say that. But typically, you will more often than not answer with the first question, given that you're still speaking with investors. Who else are you talking to? This is a very sly question. Very, very sly on the investor's part. They're trying to figure out, if you give them a name. So let's say, let's say Wesley's the investor I'm talking to. Wesley asked me, who else are you talking to? And I go, oh, I'm talking to this guy, Michael McCarthy. He's a great angel investor. I'm thinking of raising money from him. As soon as I leave the meeting with Wesley, he's going to pick up the phone. And because all these angel investors and VCs know each other, the next phone call he makes is going to be to Michael. He's like, hey, what do you think of Harry? I just met him. And either they'll corroborate against you, or they'll find faults in your respective businesses. Sometimes, by the way, there are times where it's good, but you typically want to get some commitment before you get your investors talking to each other. Okay, if you were to fail, what would be the top reason? This is another version of like what keeps you up at night. What are the failure modes of your business? You should have a good idea of what the failure modes are. Now, going through these questions, notice how some of these are trick questions or sly questions. Some of them are genuinely trying to poke at the truth. You will get some of this wrong. I did. This is part of the reason why it takes 6 months to raise money. Everybody gets it wrong. The key part is learning from this process. If you can, bring a mentor who has your best interest in mind to some of these meetings, just to be a fly on the wall and listen in and see how you answer the questions. They're typically really, really good at making sure that you after the meeting, when you're doing sort of a debrief on how the meeting went, they'll be able to tell you, hey, they asked this really sly question. Here's how you answered it. Here's how you should actually answer it. Or, hey, you answered this question about, what your beachhead is really, really well. So stuff like this helps. You make sure you have somebody to debrief with that has your best interest in mind. I know I do it for some of the IBZ teams here, but every incubator or your local ecosystem, you have advisors and folks in your network that I'm sure will be able to help you as well.
I'll just add a quick comment on bringing a mentor with you. Depending on the investors you're talking to as well, sometimes that could be a red flag in their eyes. If you are having a conversation and then you've got a mentor sitting right beside you. So I think the key phrase from Harry there is fly on the wall. So if you've got a mentor you can trust who's available, that can be at, say, like the next table, having a cup of coffee and just listening in. That's one thing, but like right beside you, it almost looks like you've got mom or dad beside you, and that could itself have a bad impression.
Yeah. And the context matters. Yeah, that's a great point, Charles. The context matters. Initially, you will take investor meetings that are like, I'm not here to pitch for money. I just want to run by pitch by you and give me feedback on how I'm doing. Here's like a pitch coach that I'm bringing along that's going to help you through the process as well. And most investors will be okay with that type of stuff. So you want to make sure you set the context right. But yeah. So yeah, you definitely don't want it to come off as, oh, here's mom and dad sort of helping me out. Okay, so I mentioned this isn't a one-way street, it's a two-way street. So there's a lot of questions you out to ask the investor as well.
Could I just ask a question, one more about the previous slide?
Yeah.
When you say what's your valuation, is this somebody does that officially for a startup, or is this just based on what amount of money you have raised for a company so far?
There are people who do it professionally, but typically at the early stage, it's not a good use of money to hire like an external evaluator. The way you do it is you figure out how much money you want to raise and look at other comparable companies. So people that might be in the similar space and how much they're raising. And typically you want to assign a valuation on the basis of that. So for example, you can go on Crunchbase and you can look up what companies and how much they raised and from what investors. A lot of this information is now publicly available, and use that as a comparable guide.
So pretty much that's how much people invested in you. That's the valuation amount.
Invested in
Or-
your competitors.
Yeah, or could invest in you potentially. Yeah.
Yeah.
Okay. Thanks.
So let's go into questions you should ask the investor. Like I mentioned, it's a two-way street. So question is like, how big is your fund, or how did you make your money? So for angel investors, you want to know that how they've made their money. For funds, you want to know how big their fund is. And the other thing you should ask is what your fund cycle is. So typically most venture funds are 9 to 10 year fund cycles, which means they need to give their money back to the LPs in that window frame. If they're already at year 3 of their fund cycle, which means they'll ask for their money back in six years. If you're not planning on going IPO, they might have to pull their money out, and it's just something to be mindful of. So you have a good idea of, what their expectations when it comes to return on investment is. What type of companies do you invest in? What's your firm's thesis? I know a lot of it you can find online, but it's always good to ask the investor. As a matter of fact, you should ask these when you first meet the investor, you should ask them these questions up front. So typically the way the conversation will go is, hey, Wesley, it was great. It's great to meet you. I know Harry introduced us, but I know very little about your firm. I'm happy to go into the pitch of my company, but I'd love to learn a little about you and what your firm is up to. And then as they give you the answer, that's when you can get a few of these questions in up front. So why are you interested in my space? What beliefs do you hold about my space? This will give you a good idea about breaking away from the investment thesis to what their values are. So a firm's thesis could be like, hey, we invest in healthcare and clean technologies, but I look at mostly healthcare deals. A partner could say something like that. And then when you say, okay, well, what beliefs do you hold about the healthcare space? And they'll typically say, oh, I get really, really excited about diagnostics. I really, really get excited about, the new insurance paper use model paper outcome model or something like this. And that way, you're searching for things that they believe in, and you can real-time modify some of the pitch elements that you'll say. What do you look for in an entrepreneur? If this sounds like dating, it kind of is. It's kind of like, what are you looking for in the person you will invest in? What type of features do you care for? What's your typical check size? What your fund cycle is? I already talked about that. What is your process to assess entrepreneurs? This is convoluted for a lot of people. But a lot of funds, if you ask them, will just tell you like, hey, we need to make a unanimous decision between our founders, between the partners when we're choosing to make an investment decision. And then we'll move to the due diligence phase, so on and so forth. One of the things you should also ask, part of the what's your typical check size, is how often do you write checks, especially to angel investors. There's tons of angel investors out there that I call social investors. They love showing up to these angel investment groups because that's their way of socializing. A bunch of their golf friends invited them, and now they're there. But they maybe write like one check in 2 years, and they're like, oh, I'm an angel investor. It's like an identity thing for them. So you want to tease out stuff like that really, really quickly. And the quick way of doing that is like, hey, how many checks have you written in the last year? And that'll give you a very good idea of, whether or not they're the social investor or not. How hands-on are you? So now this is okay. If everything works out well, typically how hands-on are you with your entrepreneurs? And I forget who asked this question earlier, but this is a good indication of what control terms they'll want to see. If they're like, I typically get on the board of the investments that I do, or I typically, ask for weekly meetings, you'll hear all types of different things. The most classical thing is they'll typically have board meetings once per quarter, or shouldn't say board meetings, an update meeting with their investment portfolio teams once every quarter, and they'll sort of try to be helpful on an ad hoc basis outside of that. And as we've discussed already, ask for references from invested entrepreneurs, the good and the bad. Once the due diligence is done, and once sort of you've answered all their questions, you want to close them in 2 weeks. Here's the reason why. It is in the best interest of the investor to drag out the process as much as possible. Ideally, the investor wants to be the last money in, because that means it's the safest. Nobody wants to be the first person to, take a new risk on. But they won't actually say that, though. The best thing they'll say is like, oh, we typically don't lead, we wait on other people to lead, and then we'll be interested. Just ignore that. The easiest way to counteract that is like, hey, we're actually not doing a priced round, and I'll talk about what that means in a second here. We're doing a safe round, so you can put your money in at any time, and that allows you to close them relatively quickly. Okay, so this brings us to the different raising mechanism. So some of you might be going, Harry, you can't do math. You're telling me 3, but you've listed 4 things here. I won't talk about special purpose vehicles now. It sometimes happens at the early stage, but it's typically a more later stage thing. I'll be focusing on what are called equity rounds, safes, and convertible debt, so it's convertible notes. So equity round is the simplest one to explain. Equity round, if anyone has seen Dragon's Den, it's like, I am looking to raise $500,000 for 10% stake in my company. It's you're exchanging shares for money. That's the limit of the transaction. There's some nuances, obviously, and one key nuance is somebody needs to price and lead the equity round. This is typically what they call the lead investor. And they'll typically take a large chunk of the money that you're trying to raise, and then you're responsible for closing out the rest of the round. Sometimes the investor will also help you close out the rest of the round as well. But this is typically how an equity round is put together. You'll have to have a lead investor, as they say. A convertible debt or convertible note is it's basically a debt instrument that can be converted to shares down the road. And the purpose here is you don't land on a valuation. You typically create what's called a valuation cap and a discount rate. So without going into the details, because this alone can take hours to go through, I've put in a few references and stuff you should look at. I've also put in a few templates at the link below. But basically, the way it works is, let's say I go to Wesley to raise money from him. And let's say he loves my company, he loves what I'm doing, but for whatever reason, we cannot agree upon valuation. So I think the valuation is $5 million. Wes seems to think it's $2 million. And so the one thing we could say is, you know what, let's not agree upon valuation right now. Let's benchmark it off of a future round we'll do. And you can give them a discount. So Wesley, because you're the first investor coming in, I'd like to give you a discount on the deal. I'll give you a 20% discount on my round so that I can raise, and then whatever compared to what future valuation I will get. And then there's no valuation set, there's just this discount that I go off of. And then depending on how you structure the deal, they might have an option to claim the debt back at some interest rate, and then you can use the money that you've raised in the future to pay that sort of debt off and pay the investor off. Now, a lot of people don't do convertible debt that much anymore. It was very popular a few years ago, but these days, the most popular way of raising money at the pre-seed and seed stage is what's called a SAFE. SAFE is essentially like a convertible debt, except there's no debt. It's like you do not agree on a valuation, you'll get converted to equity somewhere down the road. And the big positive of running a SAFE or running a convertible debt is you can close people on what's called a rolling basis. You don't need a lead investor to set everybody up and create a valuation. So whenever I started opening my round, I was raising at what's called a $5 million cap. But by the end of my seed round, after I talked to 117 investors, I ended up raising at a cap of $60 million. So as I got more and more money, I built more and more interest, I could demand a higher price or better terms for my round. I know I'm going through this very, very quickly, and I'm explaining this at a very high level. There's tons of documentation and videos about this online that you can look at. I specifically recommend this one book called Venture Deals by Brad Feld. I think we can edit this portion out. We have a free copy of that available. Oh yeah, Charles has a copy. We have a free copy of this ebook version somewhere on the wiki. Wes or Grace, if you mind putting a link to that, that would be awesome. Okay. I'm going to zoom through the next portion and leave some time for questions. So raising money from government grants and pitch competitions. Everyone has a different strategy here. I'm just going to walk you through what worked for me. I ended up raising around $500,000 in grant and pitch competition money before I seriously raised my seed round. And the way I did it is for the first $50,000 to $100,000, I wrote all the application myself. Once I won a few of these pitch competitions, I hired, a grad student who was smart but had nothing to do over the summer. It's like, hey, you want to get some startup experience? And I basically got them to apply for all these grants along the way. And all I would do at the end is kind of like review the stuff that they had written, modify it, and then go in for the pitches whenever we were selected. And this saved me hours upon hours of work. And it led to us raising literally 5 times the money that I could have raised on my own. The other thing you have to do is build a lot of internal networks at these different government agencies. We have created a funding portal at IBZ that lists out any grants within the Canadian ecosystem that deep tech companies or projects like yours can apply for. They're not applicable to everyone, obviously, but you can definitely find something that's of use to you. There's tons of this type of availability on the funding portal. Wes and Grace, if you can link that, that would also be awesome. Ultimately, it's a numbers game. Anyone want to take a guess how many grants I applied to? Let's open up chat. Okay, Calvin has 4x his previous guess. I like it, Cal. 20, okay. So because we were a deep tech company, there's a lot of money out there for us. I think I must have applied to about 150 grants altogether. And we ended up getting, we did a little better than 10%, but average success rate based on the startups that I advise is about 10%. So you want to get in as many applications as possible. Even if you think you're ineligible, apply, because a lot of grants go unfulfilled. So they'll make exceptions if they like you. I think I talked about how I think about pitches, and not just verbal pitches, but also written pitches in this sort of same way. There's the fundamental plan, and then from there, you'll use the same elements in each of your pitches, but then also the written version of this. I've talked about elevator pitches, the standard pitch, and the long pitch, so I won't get into this. I'll end off on this note. There's these 3 ways of getting, actually, before I end off here, any questions about grant writing? So as I mentioned at the beginning of today's talk, there's 3 ways of bringing money into your company: investors, grants and pitch competitions, and sales revenue. You're constantly going to be jumping between these. It's not like at the early stage you do grants and then you forget about it. It's going to be a constant thing you go after. IRAP has hundreds of thousands of dollars that they give out in grants for development projects. FedDev, other government agencies also do this. There will always be investors around. I hope what you've taken away today is the work and what you will need to do in order to go raise the respective funding from at least 2 of the 3 sources. And hopefully your customer discovery can help you good idea of what it takes to close the sale, and figure out, first of all, figure out that there's a market need. And then if there is, what the process of purchasing your respective solutions will be. But hopefully you have the data necessary, at least a starting point necessary to figure out which will be the right path for you as you move forward beyond lab to market. And we'll be discussing this in a lot more detail next week in the next steps, and how to think about what you end up doing next once the program ends. So with that, I'll sort of stop there and see if there's any final questions. Sorry, Wes, I know I'm a bit over time, but it was an exciting topic. Thanks for all the questions. If there's any more, I'm more than happy to answer them.